Conrad, thanks so much for your time. I was reading a note yesterday that the sell-off in the week to Friday, so that's June 13th, that this was the biggest sell-off we've seen since the US presidential elections in 2016. Is it that bad?
Yeah, it's been quick, and the magnitude has been fairly significant, which is what tends to happen to our market when liquidity disappears. Sure. And panic and negative sentiment sets in.
Mm-hmm. I mean, if we dial back, this week we're confronted with these escalating trade tensions, but last week's move weren't so much to do with trade tensions, but sort of rising interest rates in the US, as I understand?
This is what's making active fund management locally so difficult. There's so many moving parts, and we lurch from week to week where it's global factors driving us one week, it's domestic factors the other week. So really difficult to put the puzzle together and to figure out what the underlying theme is in this market.
All right, so it's mainly foreign sellers that are offloading their position in our bond market. Where are they taking their money?
Yeah, this is an interesting thing. I mean, we've always had this vulnerability hanging over our South African bond market. Foreigners own nearly 1 in 2 of every Rand South African bond, which makes us vulnerable to what they do with their capital. When you get the negative sentiment like we've got now, you always find what we call the FOST money or the tourist money. They exit first and they'll go, and they've got various options across the world. You're then left with the more real investor money, and to me that's not exactly obvious where they would put their money. If you're going to exit a South African bond paying you nearly 10% yield in the long end of the curve, where do you go to your money? Where do you put the money? If you go to a US bond at 3, that's a 7% interest differential between US bonds and South African bonds. Mm-hmm. So you need the US dollar to then strengthen by 7% to put you in the same position as you would have been if you had stayed in the South African bond. So in this environment, it's not clear to me where money leaving emerging markets goes. Do you want to go into US bonds, where you've got record levels of bond issuance by Trump and this deficit that's going to increase by $1.5 trillion over his tenure? Do you want to go to European bonds, which are still pretty much at or close to zero interest rates? It's not, the alternatives are not particularly appealing, and this is why I think we might be in a position where once this FOST money is gone, sure, it calms down a little bit.
Could it be that, although I do believe this might be a dumb question given what global markets are doing right now, but could it be that they're rotating their assets, so they're coming out of bonds and then going into other instruments like equities?
That could well be. I mean, the theme there being that this late cycle growth spurt in the US caused by the tax cuts that are coming through there, and some of the infrastructure spend will give a last push to the equity market. But valuations are already pricing a lot of that in, and the danger with a late cycle spurt is that it often can fade quite quickly, and the Fed is hiking interest rates at the same time, the dollar's strong. So, could be going into equities, but I think that's a very short-term trade that might end quite badly.
Okay, so we don't know where it's going, but one thing that we do know is that local investors are turning a more favorable eye to government bonds. I understand that they've stepped into the market quite a bit. Is this more positive for us to, have ownership of our bonds more towards local hands?
Yeah, as I said, foreigners owning such a large proportion of our bond market makes us quite vulnerable to their whims. We have one of the highest foreign ownerships of our local bond market in the entire emerging market universe. Having said that, though, we have a very stable, very deep domestic investor base that invests in bonds. And as you correctly point out, we've done some work recently and published a piece that suggests, for every bond that a foreigner sells, there's a domestic investor that's there to take it up. Maybe not at exactly the same yield, so you do find some moves. But if you put the domestic banks, the domestic insurers, the domestic asset managers, all in the same pot, and you're looking at yields of 10% at the moment, with inflation, let's use round numbers, at 5%. That's a 5% real rate of return for a domestic investor. And certainly from our perspective, that looks quite appealing at the moment. And so we're certainly upweighting our exposure to domestic bonds, almost taking the place of a foreign buyer that is now exiting. that brings an element of stability to the domestic market. And I think it's becoming more and more widespread in this environment where it's quite hard to find return. 10% or double-digit bond yields for a domestic investor whose liabilities are in rands makes a lot of sense to us.